Welcome to this week. This week we'll be focusing on chapter 8, which is current liabilities. So far we've looked at different aspects of financial accounting. Some of the information we look at are typical to be used for financial statement and the balance sheet. So our key focus for this week will be the current liability, which is part of a session that has to be prepared in your balance sheet. So typical structure of a balance sheet, just to recap, you will have the current assets, and then you have the fixed assets, and sometimes people call it the long-term assets, where you have the PPE, property, plant, and equipment. And then after that, the next section of the balance sheet is your current liability before you get to long-term liability and the owner's equity. So we're just going to focus on a specific part of that balance sheet, which is current liability. It is important to study this because you learn how to create a journal in terms of what goes into debit and credit and how credit will increase your current liability total and debit will reduce your current liability total. So we want to understand that effect on this chapter as well. So here are the key learning objectives. The number one learning objective is to understand the difference between the current assets and the current liability and then the long-term liabilities. And also to understand what we mean by notes payables and interest expenses. We're also looking at a pre accounting in terms of the payroll and the prior tax liabilities or other deductions that would be typical for a payroll system. And then we'll look at the um, accounting for other types of current liabilities, such as interest payable, for example. We could also look at unearned revenue, for instance. There could also be liability or litigation, contingency, and many. So the part two or the part B of this chapter focuses on applying the appropriate accounting treatment for contingencies. Contingencies are sometimes unplanned expenses or routine expenses that have to be completed. And then we'll look at some real world example on that. And then you are also expected to assess what we mean by liquidity, be able to evaluate whether you have enough assets that will cover your liabilities in terms of your debt to asset ratio. So do you have more assets than your liability, or do you have more debt than liability? That is something that we'll look at on this chapter as well. And then lastly, we'll look at long-term liabilities, which is going to be a more key focus in subsequent chapters. So we're just going to have a quick look on this, which is going to be the next thing that we'll be looking at after this topic. Now, the current liability will be any debt that you owe as a company or a business that has to be paid within 1 year. Unlike the long-term liabilities will take more than 1 year to remedy that debt, which means to pay those debts. Those are debts that are typical things like loan that you take from bank, or higher purchase that you have to pay monthly, but you could pay it over 36 months or 48 months, 76 months or 72 months or many years. So those are long-term debts where you have to be paying that for several years. And sometimes portion of the long-term debt could become current liability, because if you were to repay some part of debt, and that part has to be paid that year, so that has to be paid. It's a portion that now goes into what you have to pay within that year. So let's look at some examples. We could look at account payable or wages payable. That's a current liability because that has to be paid. Those are a employee expenses. That has to be paid in the year they are incurred. Imagine you do not pay your employee in the months that they work. So you probably run into trouble with staff not coming to work. The long-term liability, for example, we'll be looking at bond payable or long-term loans. So I talked about that earlier. So here's an example. Here's an example. Company owes suppliers $5,000 due in 30 days. That is a current liability. But if you owe $50,000 that is due across 5 years or in 5 years' time, that will be considered as a long-term liability. Now, let's look at note payable. Note payable, sometimes some textbook will call it promissory notes. So these are notes that promise that you're going to remedy certain promises or debt covenants within a period of time. So note payable could be an agreement that you sign to be able to make payments to an individual or an entity given a particular transaction. And interest is typical um, compensation that you make as a result of the money that you borrow or some equipment that you rent or for some other kind of debt instruments that you may hold. So how to calculate the interest is typically your principal multiplied by your interest times time. So some of you will be looking at this more in detail in annuity. If you are taking finance, it's definitely one of the things that you cover in more detail. But of course, we also cover this in quite substantially well on chapter 8. Here's an example of the calculation. So we could look at borrowing or lending that amounts of $10,000 multiplied by 6% for 1 year. If we're looking at current liability. So that is a typical $600 as interest that you have to pay for the principal that you lend. So the interest itself could be current liability. The principal could be for years. So it could be the principal itself could be money you borrow for across many years. But the interest on that principal becomes current liability. Now, the payroll liabilities is, we know what payroll is. So these are compensations for employees. And this compensation will be considered as current liability. You look at the gross payroll, you look at the tax deduction that has to be paid to the government on behalf of the employee, and also the tax that has to be paid by the employer themselves. So employer's tax, this could be tax on social welfare benefit provided to the employee. And sometimes it could be tax on 401k or whatever kind of scheme that the employee have benefit on. All of those expenses related to labor costs will have to be paid within 1 year period. Now let's look at the other types of current liability. There are quite a lot. We can't really list them here. They will differ by company. So in a real business situation, you're going to have very many number of current liabilities. For example, your payment for electricity, for internet, your car hire, for example. All of these are current liability. Maybe staff travel for business assignment, and then you don't really pay until the end of the month. Some businesses operate on credit. For example, they purchase raw materials, and those raw materials they purchase are not usually paid in the month they are purchased. They are paid later. So that becomes part of account payable. So there are quite many, and it's inexhaustive to list all of them in a textbook situation. But a good example that is not that most students tend to struggle with is unearned revenue. For example, you subscribe for your mobile phone subscription, and then you pay 1 year upfront. That company has not earned that revenue by accounting principle. It is a contract between you and that organization, but they require you to pay for the mobile service or the full service for 1 year so you could enjoy some discount, that kind of thing. When that company received that money, the for example, in this case, 1,200, that 1,200 is actually not earned. And because it's not earned, is a liability. So that will increase their current liability by default. But every month they could charge to you, they may be charging you $15 every month for the service you subscribe for. So in every month, in this example we have is $100. So every single month they will have to create a journal to to create a portion of the 1,200 that you paid by debiting your unearned revenue account and then credit your revenue account. So that will reduce their current liability and increase their revenue because they've now earned that portion of $100 out of 1,200. So there's a good example from your textbooks that may also talk about this, or you could also do more research just to learn more on how do you account for unearned revenue. So this is very important and it's very typical with many businesses. Now, contingencies. So contingencies are usually potential debt liabilities. This could include things like lawsuits. Let's say, for instance, there's a lawsuit, and then as a result of that, the plaintiff won the case, and then the court asks you to compensate the plaintiff, and you have a loss of $8,000 as a result of that. So typically, you create a journal for that by debiting your current account, $8,000, and then you credit your liability by 8,000. So what that will do, it will increase your liability. So you could debit your other account, which could be the plaintiff or compensation that you have to pay. So when you credit your current account, as a result of that, that will increase your current liability. So liquidity ratio is basically testing your assets to debt. So typically it's trying to see what is the portion of your debt given your total assets. Or your current assets, I mean. Your total asset would be your current asset plus your fixed assets. So in this case, we're looking at current assets to current liability, okay? So now your liquidity ratio is testing your ability to be able to pay your short-term debt within a 12-month period. And how we calculate that, we typically divide your current assets by your current liability. As you could see from here, your current asset is 20,000 and then your current liability is 10,000. So your liquidity ratio is 2. So your asset is twice your debt, which is great. But the higher the liquidity ratio, the better or the most safe a business is. So to summarize, we look at the current liabilities and differentiate that from the long-term liabilities. So short-term debt or current liability are short-term debts. Those are debts or liabilities that have to be paid within a 12-month period, while long-term debts will be paid across debts that could take more than 1 year to pay. So these are debts that the company owe other people in other ways. We need to have a proper accounting record for current liability because once you don't have an accurate record of your current liability, that will affect your balance sheet. Your balance sheet may not balance in that case, and you will have inconsistent accounting record. That could lead to some fine from government regulators, such as, for example, if we look at Security and Exchange Commission for large businesses that are listed. If you don't have good accounting record, that could result in significant cost to the company because they'll pay fine, and then we also have public reputation issues. Then the other thing that we also cover is types of current liabilities such as interest, payroll, contingency, and require estimation. And lastly, we look at liquidity. Liquidity is looking at the percentage or you put it this way, say a percentage, we look at your debt to current asset ratio. So we're looking at what is the portion of your current liability from your current assets. So we're looking at current assets and current liability ratio. So the higher that ratio, the better the company is in terms of their ability to pay their short-term debt. So this is where we'll stop. Our next focus is going to be chapter 9.